Hello and welcome to my channel. Today, we're diving into a topic that's particularly interesting for investors looking for stable and regular income: dividend stocks. But what exactly are dividend stocks, and why are they so attractive to many investors? Dividend stocks are shares of companies that regularly pay out a portion of their profits to shareholders. These payouts, known as dividends, can provide a reliable source of income without the need to sell your shares. For retirees or investors seeking passive income, dividend stocks are an appealing option. In this video, I'll walk you through the 5 most important reasons for and against investing in dividend stocks. By the end of this video, you'll have a clearer idea of whether dividend stocks are a good fit for your portfolio. So stick around. Reasons for dividend stocks. Reason 1. Regular income streams. One of the biggest advantages of dividend stocks is that they offer regular income streams. These payments often occur quarterly and are particularly attractive in times of low interest rates, where other investment forms like bonds yield less. This makes dividend stocks an excellent choice for those looking to generate consistent income without needing to sell shares. Dividends can, for example, be used to cover expenses or serve as additional retirement income. Reason 2. Lower volatility. Companies that regularly pay dividends are often established firms with stable business models. This stability leads to lower volatility in stock prices. While growth stocks often experience significant fluctuations, dividend stocks tend to show more consistent performance. For investors who want to take on less risk, this is a major advantage. Large corporations like Procter & Gamble or Johnson & Johnson are classic examples of these stable dividend payers. Reason 3. Dividend reinvestment. Another often overlooked benefit is the compounding effect that comes from reinvesting dividends. When dividends are reinvested, investors can buy more shares and let their portfolio grow exponentially. Over a long period, this can significantly impact the overall value of the portfolio. Regular reinvestment can turn a seemingly small dividend amount into substantial growth. Reason 4. Indicator of financial stability. The regular payment of dividends indicates that a company is financially stable and profitable. Dividends are typically paid from profits, and companies that consistently pay or even increase dividends over time demonstrate their ability to generate steady profits. For investors, this is a sign of trust in the company's long-term stability and future. Reason 5. Tax benefits. In some countries, there are tax advantages for dividends. For example, dividends may be taxed at a lower rate than other forms of income, or there may be allowances that can be used. These benefits can increase the effective return on dividend stocks, making them particularly attractive for tax-conscious investors. However, it's important to carefully check the specific tax laws in your country. Reasons against dividend stocks. Reason 1. Lower growth potential. A common argument against dividend stocks is the potentially lower growth potential compared to companies that pay little or no dividends. Companies that distribute a large portion of their profits as dividends may invest less in growth initiatives, such as research and development. This can lead to slower price appreciation as less capital is available for expansion. Growth investors may therefore find dividend stocks less attractive. Reason 2. Taxation of dividends. Another downside of dividend stocks is the taxation of dividends. In many countries, dividends are subject to double taxation, first on corporate profits and then on dividend payments to shareholders. This tax burden can significantly reduce net returns, especially for investors in higher tax brackets. Compared to growth stocks, where profits may only be taxed upon sale, dividend stocks can be less appealing. Reason 3. Dependence on corporate profits. Dividend payments are not guaranteed and depend on the company's earnings. In times of economic difficulty or declining profits, a company may be forced to cut or eliminate its dividend. This can be especially problematic if you rely on that income. Moreover, a dividend cut often signals deteriorating business conditions, which can lead to stock price declines. Reason 4. Inflation risk. Dividend stocks also carry inflation risk. As inflation rises, the real purchasing power of fixed dividend payments declines. While other asset classes like real estate or inflation-linked bonds offer some protection, dividends typically remain constant. This means that the real return on a dividend stock can be eroded over time by inflation, making them less attractive in periods of high inflation. Reason 5. Price risk. Dividend stocks are not immune to market fluctuations and can suffer significant losses during a market downturn. Even if a company continues to pay dividends, the decline in stock price can severely impact overall returns. A significant price drop could wipe out the dividends over a longer period. Investors should be aware that while dividend stocks provide regular income, they also carry the risks associated with the stock market. Conclusion. In summary, dividend stocks offer an excellent way to generate a regular income and benefit from stable companies. They offer lower volatility and can generate significant returns by reinvesting dividends over time. However, dividend stocks also have their downsides, such as lower growth potential, inflation risk, and potential price declines. If you are a long-term investor looking for stability and regular income, dividend stocks could be a good addition to your portfolio. If, on the other hand, you are looking for fast growth and high capital gains, you may want to consider other investment strategies. What do you think of dividend stocks? Have you already invested in them? Let me know in the comments. Don't forget to like this video and subscribe to the channel so you don't miss any more content. Thank you for watching the video to the end. See you soon.